Exercise 4-19, we're going to create a classified balance sheet. The classified part of the name means we're going to divide the asset section between current assets and then property, plant, and equipment. And then we'll also take the liabilities and divide them up between current liabilities and long-term liabilities. So the adjusted trial balance of Melanie O'Malley Dance Studio Company follows. So here we've got our trial balance, and notice it says adjusted, so that means the adjustments have been incorporated. So this is ready to go for our financial statements. Then it says prepare the classified balance sheet for the company as of the end of August. Use the report form. Report form just means assets on top, liabilities below, and then equity underneath that, as opposed to assets on the left and then liabilities and equity on the right. You must compute the ending balance of O'Malley Capital. So, just like, let me find my financial statement formulas, just like we do when we're creating our financial statements, we have to create income statement and then the statement of owner's equity, and then we're going to take the ending capital from the statement of owner's equity and put it as the ending capital on the balance sheet. Notice we cannot use this capital because it is not the ending capital. So they do not provide us with the statement of owner's equity, which is what you would do in the real world. So what we'll have to do is back into the ending capital by just inputting the number that will make the balance sheet balance. Begin by preparing the asset section for the balance sheet, then prepare the liability section, and then finally the owner's equity section. All right. So notice our trial balance as always is organized by account assets first, including the contra asset, liabilities, and then capital, draws, revenues, and expenses. So we can go in this order. So our first section for assets is always current assets, and cash is definitely a current asset. I copy and paste the dollar amount. Office supplies is also a current asset. Now remember, the definition of a current asset is an asset that's going to be used up or turned into cash within the next 12 months. And the amount of office supplies is $1,800. Usually you will use up your office supplies within 12 months. That's why it is a current asset. And then prepaid rent, we expect to use that up within the next 12 months. So that is also a current asset. Prepaid rent. Now this horizontal line means we're going to do some sort of mathematical operation. In this case, we're going to add these, and this becomes our total current assets, and that amount is $19,300. So next, what's after the current asset section? It's the long-term assets, but they never call them that. They call them usually property, plant, and equipment, or PP&E. And then let's see what type of basically they're long-term assets. So this, we got equipment, 49,000. And then we have to have its contra asset, 5,700, accumulated depreciation right with it. I'm going to put that as a negative to remind me to subtract that. I don't believe you have to put the negative sign. Let's see here, accumulated depreciation. So 49,000 minus 5,700 gives us a book value of 43,300. But that's the only property, plant, and equipment, so we're going to put the label of total property, plant, and equipment. And then so we've got our two types of assets, current assets and total property, plant, and equipment. So we're going to add, remember this horizontal line means we're doing a mathematical operation, so we're going to add this plus this, and that gives us total assets of 62,600. Where is my check answer? Fantastic. Now watch as I click OK. It's probably going to take remove my negative sign and put parentheses because that's the more formal way to do it. But notice it did accept that minus sign. Now we've got our liabilities. We need to combine or separate them into current liabilities and then long-term liabilities. So accounts payable is definitely due to be paid within probably the next month, next 30 days. So that is a current asset, or excuse me, current liability. Accounts payable. What else we got? Salaries payable. The next payday is within the next 2 weeks probably. So that's definitely a current liability. Salaries payable. Unearned revenue. That is a liability, and that's a current liability also. You expect to get rid of that liability within the next 12 months. Where are you? And then our notes payable is long term, so we're done with that current asset section. So 4,800 plus 100 plus 5,000 gives us total current liabilities of 9,900. And then we've got our long term note payable, 5,400. But I need the label. Long term liabilities, note payable. And so now we're going to take the $9,900 of current liabilities, add it to the long-term liabilities of $5,400, and we get a total of $15,300 of total liabilities. Okay, now alert, alert, alert. A lot of you are going to miss this point because you're not paying attention. It says you must compute the ending balance of O'Malley Capital. Again, like I mentioned before, in the real world, you don't have to compute it because you would take the ending capital from the statement of owner's equity and input it over here in the balance sheet. That would make a balance. However, they don't give us a statement of owner's equity, so we must back our way into that. So because this is a balance sheet, we know that the total liabilities and owner's equity must equal total assets. So it must equal 62,600. So to calculate capital, I need to figure out 15,300 plus what equals 62,600. So to calculate that, I'm going to take 62,600, which is the same as total assets, 62,600 minus the 15,300 total liabilities, gives me a total capital of $47,300. So just double check, does this plus this equal the same amount of your total assets? And it does. Excellent. One more thing. Compute O'Malley's current ratio. 1 year ago it was 1.76. Indicate whether it's improved, deteriorated, or remained the same. So the formula is total current assets divided by total current liabilities. So total current assets is 19,300. Total current liabilities is 9,900. So let me plug that in, 19,300 divided by 9,900 equals 1.94. Round to 2 decimal places, 1.95. 1.95. And then, did it get better or worse? So it was 1.76 and is now 1.95. So the question is, do we want this to be high or low? Well, we want this number to be super huge, like maybe $1 billion. And we want it like $1 billion current assets versus $1 current liability. So we want this to, the result to be larger. So it did get bigger. So therefore it improved. And that's it.